It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. First of all, I want to welcome a number of new listeners in a number of different markets. San Francisco, Dallas, Boston, Phoenix, Minneapolis, and San Diego. We all have new stations, new listeners added to the show. And welcome. Hope you find the information very beneficial. Again, try to use some common sense. Make sense of what's going on in the world today, how it affects our money, allows us to make better decisions, all that type of thing. And I'm blessed, like I've often shared, no one's telling me what to say or what not to say, which is very rare in media today. So I understand I'm truly blessed by that. And I'm just, trying to use some common sense and use some experience. 25 years in the financial industry, over 30 years as an entrepreneur. I've owned several businesses. I always say, yes, I'm a financial guy, but I'm truly an entrepreneur at heart. My first business was a retail plant nursery. I've owned a number of real estate properties. My wife and I actually owned 32 properties at one point. We learned a lot of lessons from that. We did really well. We also made some mistakes that we learned from it. Of course, I started the financial agency 21 years ago now. It's been very successful. It's probably my main gig, if you will. And for a couple of years, I was chairman of the board of an FDIC-insured bank, so I learned a lot about the banking industry, which is very different than the financial industry. One of the things, I get asked this often, is I was surprised how little cross-pollination there is from the financial world to the banking world, and they are two different worlds. And that is part of where I came up with the Your Personal Bank concept, to grow your money insured, guaranteed, tax-free, highly liquid, much like banks do, by the way, in their portfolios. But then also taking it another step beyond. Many of you have been introduced to the insurance banking concept or bank on yourself or many other names that are used, but taking it to another level by using bank lines of credit to access the funds most of the time to create larger positive arbitrage. In fact, the actual average positive arbitrage of what you're earning in dividends minus what you get charged in interest when you access the funds is about 2% over the last 40 plus years, which is far greater, actually about double the positive arbitrage that you often can get through using just policy loans, which is what most people teach. So that's one of the big differences. And again, just for you new listeners, welcome to the show. I'll share more about how the personal bank concept can work for you to enhance your returns, reduce your market risk, reduce your income taxes, enhance returns on your money, and create positive arbitrage. In other words, learn how to earn interest on money even after you invest it for other things or use it to purchase items or pay bills even, much like banks do. I share this idea often. You can love or hate banks. Doesn't really matter. We can agree they're savvy about money. We can certainly learn from them. And that's one of my primary missions of this show, is to educate people that there's another way. So many people I run into often ask, well, I'm familiar with the stock market or real estate investing, maybe some crypto, precious metals. What else is there? And they don't realize that there are other options out there that are safer, often outperform over time, especially with less taxes, higher liquidity, your personal bank being one of those main tools that is used often by the wealthy, by banks, institutional investors, and et cetera, for literally decades, well over 100 years even. This is not a new idea. It's just new to most average investors, or what Wall Street terms as retail investors. And that's typically what they loosely define as someone with less than 10 million in liquid assets, which of course includes most people. The institutional investor world, banks, pension funds, the big investors are very familiar with the personal bank concept and using insurance as a tax-free tool investment tool, create liquidity, positive arbitrage, all that type of stuff. In fact, this was something we discussed at our bank board meetings quite often because FDIC terms this as Tier 1 capital. Many people are not familiar with what Tier 1 capital is. It's an FDIC term. Of course, any FDIC insured bank is required by FDIC to invest a portion of their portfolio in what they consider or they define as Tier 1 capital. Now, Tier 1 capital, there's only 3 types of assets that fall under that category, which, by the way, is considered the safest capital or investments by FDIC. And those 3 assets happen to be cash equivalents, which are like checkings and savings accounts. These are accounts that have easy, quick access to, and cash value and insurance policies. That's it. And when you understand that FDIC pretty much requires the regulators about 25% of the typical bank's portfolio to be invested in that type of capital, Tier 1 capital, well, why would a bank put their money in cash or checking or savings types of accounts that interest rates are going to be pretty low, the returns are going to be pretty low, when they can put it into cash value insurance policy and earn 6% plus today, tax-free, insured? My gosh, that's kind of a no-brainer. And that's why literally there's a whole category called BOLI, bank-owned life insurance. And banks buy this stuff by the truckload, literally by the billions every year. So again, it's not a new idea. It's not even an uncommon idea. It's just uncommonly known in the retail or the average American. And that's one of the main purposes of this show. Those of you that have been listening for a while, I thank you. I appreciate it. I get lots of positive feedback. And again, I welcome all the new listeners. Now, one of the big things that's been going on recently that's of great concern for many people is the stock market is in correction territory. Now, the big question is this merely a correction, or is it the beginning of the next downturn or the next bear market? Now, I find it very ironic. As I stated earlier, this is my 25th year in the financial industry, and we hear this every time the market takes a downturn, the advice, and you know what I'm talking about. You've heard it yourself. Stay the course. Hang in there. It'll get better. All that type of stuff. Now, why do we hear that advice all the time? Well, there's several reasons behind it. But what I want you to understand, what I feel is so ironic, is you look at institutional investors, hedge funds, even Warren Buffett. All of them, for the most part, have significantly reduced their exposures to stocks and equities recently. In fact, hedge funds sold the highest percentage of stocks in early March of 2025 since the 2020 COVID correction. Warren Buffett, I've shared on the show many times, has sold the most stocks last year in 24, both in total amount of dollars and percentage in his entire investing career. By the way, he did the same type of thing in 2007. Does anybody remember what happened in 2008, 2009 in the stock market? Well, the S&P dropped about 55%, top to bottom, over the next couple of years. His timing was fortuitous. And what I find ironic is that this happens, I see this happen over and over and over again. Again, we saw it in 2020 prior to COVID correction. We saw it prior to the 08-09. In fact, we saw the same thing before the dot-com bubble burst in 2001. Now, why are we given the advice to hang in there, to stay there? It'll get better. That advice has some truth to it. And part of it is, if you have a long time to wait and recover, you're younger, you're in your 20s or 30s, maybe even 40s, do you have time to weather the storm? Yes, the answer is yes. And if it's already gone down, you have the time to weather the storm. As we get older, of course, we have less time. It's just a fact of life. And how long does a typical correction take? Top to bottom and then recovery period. Well, do you remember, those of you who are old enough to remember the dot-com burst, after that, there was something called the lost decade. And what it meant was if you had invested in 2000 at the peak, it was about a decade later before you got back to even. The 0809 market crash or Great Recession took about 7 years, top to bottom, to recover. Now, if we're headed into the next bear market correction, how long will it take to recover to get back to where we were? Just looking at history, 5 to 10 years is the historical averages. So one of the questions I ask people all the time is, should you hang in there? Or they ask me this. I'll say, should I hang in there? Well, do you have 5 to 10 years to wait to get back to even? Because that is certainly potentially can happen based on history, previous corrections, previous bear markets. That's exactly what happened. Just look at the charts. Now, if you're not as inclined to ride that roller coaster, as I call it, you don't have to. Again, there's safe options. Your personal bank is one of them. Annuities, guaranteed income riders, all have the ability to guarantee at least a portion of your portfolio from downside market forces. And one of the advantages the personal bank has is the liquidity. Typically, you're looking at 2/3 up to 85% liquidity day one. And I have many clients that move a portion of their portfolio into a personal bank to earn 6% plus, guaranteed, tax-free. By the way, 6% tax-free, for example, equivalent return for most Americans of 7 to 9%, depending on your tax bracket. For example, if you got an 8% return and you had a 25% tax, state and federal, which is pretty typical, average American, your return after you paid taxes would be 6%. 25% of the 8% is a 6% return. Most people are pretty happy with an 8% return annually. And by the way, when you look at other assets like IRAs and 401ks and other qualified plans, yes, they're tax deferred, but you still end up having to pay the tax when you take it out eventually at whatever point that may be. So my point is they're not tax free. There's a difference, a major difference. These are things that we discuss when I meet with people and talk to them, and it has a lot to do with their risk tolerance, frankly. What type of investor are you? One question that's often asked to gauge your risk tolerance is, if your account's lost 20% in the next month, would that bother you? Would you lose some sleep? And that is certainly possible. We've seen those kinds of things happen, even in the relatively recent past. If the answer is yes, it would bother you, you probably should consider reducing some of your exposure to the downside risk. Just from a personality standpoint, it may not be the best fit for you. If you want more information on this, again, contact me at yourpersonalbank.com, and I'll be happy to share with you options that you may not have considered before. I'm going to encourage you to stay tuned in the next segment because this market correction that we're seeing, we're definitely in correction territory at this point. One of the major concerns is the upcoming reciprocal tariffs. We're going to talk more about that in the next segment, so stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So what's causing this correction we're seeing in the markets, this downturn we're dealing with, and how bad, how long will it be? Those are all questions people are asking right now. Well, the primary concern is the tariffs, and most importantly, the reciprocal tariffs that are set to go into effect April 2nd of 2025. And what the reciprocal tariffs are is really quite simple. Many countries have tariffs on products that come into their countries that our producers try to sell into their countries, yet have far less or even no tariffs coming for them to sell those same products into our country. And a common example I've used is Canada. And Canada's an ally, absolutely, a neighbor, a friend. Yet, if you take many of their dairy, cheese, chicken, those types of products have 200 to 300% tariffs. In other words, if you're a dairy producer in the U.S. and you want to sell into your dairy or cheese or whatever into the Canadian market, you're looking at 200 to 300% tariffs, which means in effect that market is closed. Yet if you're a Canadian producer and you want to sell into the U.S. market, there's, I believe, no tariff or very little. Now, that's certainly not fair by any stretch of the imagination, and this has been going on for years, even decades. You can take this multiplied by nearly every product you can think of and nearly every situation that the tariffs are far, far higher on products, our products going to other countries' markets versus coming into the U.S. And all that the Trump administration is doing is saying, look, whatever tariff level you have set, we're going to match it. The problem this causes is uncertainty. It really is dependent not so much on Trump. He's made his position clear. He wants fair trade, not free trade. And fair trade is equivalent tariffs. Many of these countries have been responding with, frankly, temper tantrums because they're frustrated. They've been able to take advantage of the U.S. market for years and decades, and this is coming to an end, and they're not happy about it. So we're seeing a lot of responses that are causing quite a bit of uncertainty. So please understand this. The uncertainty is not coming from Trump and the Trump administration. The uncertainty is coming from the responses of the other countries. And I think most people, when asked, should Canada be tariffing chicken and dairy to the U.S. 200 and 300% while we don't to them, would certainly consider that unfair. No question. So the bottom line is it's about fair trade. Well, the other piece of this is, again, in most situations, especially, again, sticking with the Canadian example, is our market, our economy as the U.S. is so much larger than Canada's or most other countries. For example, U.S. economy is about 14 times greater than the Canadian economy, plus the amount of tariffs, the U.S. products that go to the U.S., partially because of the high tariffs that have been in place for so long, is literally around 1% or so. So it's a tiny percentage of our economy that is products that go into Canada, yet about 25% of the Canadian market economy is products sold into the U.S. So this is going to have a massive impact on the Canadian and Mexican and many other countries' economies, and we'll barely notice. It'll just be a tiny blip on the screen, frankly. So if it does devolve into a trade war, they're going to lose that. There's going to be devastating effects to their economy and barely touch ours. So who's going to win that war? Let's face it, the U.S. is going to win it, probably in short order. So it's unlikely these trade imbalances are going to evolve into significant trade wars. And like I said, I did share some of this last week, but I think it bears repeating because it's so significant. All the tariff stuff that's occurred so far has just been preliminary negotiations. Tariffs are on, they're off, they're up, they're down. It's hard to keep track. All that's preliminary. The true reciprocal tariff, though, across the board does not take effect until April 2nd of 2025. So we really don't know yet what the impact is going to be, and we won't know for several months at minimum. And that's why the market is concerned. One of the things the stock market hates is uncertainty. And no one really knows what's going to happen or how much impact it's really going to have because the Trump administration is upending decades of economic status quo. And even Trump, our Commerce Secretary, our Treasury Secretary, others have all stated the same thing, that there will be a transition period. There's going to be a period of uncertainty. We need to be prepared for that. And I've used this analogy. Again, I will do it because it's so appropriate. The U.S. economy is much like a oil supertanker, a huge ship. It's a massive economy, and you don't turn that on a dime. It's going to take some time. Most experts, most economists believe all this will get settled out over the next 12 to 18 months. That's the time frame that I hear most often. So we're going to have a little patience. We're going to have some uncertainty. We're going to have some economic chaos, if you will, but it's for a greater good. Because as I stated earlier, it's short-term pain for long-term gain. It's kind of like when you first started to work out and exercise and eat right. It's not fun at first. It's kind of painful. If you've not been eating well and you've not been exercising, your muscles are sore. You can get headaches. It's not fun because your body is fighting you on that change. We all understand that. We're going through that same type of change, that same type of reaction that's maybe not going to be so positive. In fact, there's going to be some negatives, some impacts on it. But the long-term gain of eating healthy and exercising and working out, you get healthier, you feel better, you get stronger, you have more energy. There's so many good benefits of it. Longer term, everyone understands that. You just got to get through the short-term pain to obtain the long-term gain. And that's what we're looking at here from an economic standpoint. Again, fair trade versus free trade. Free trade, if you look, the ideal situation would be is there would be no tariffs on anything, anywhere, and it'd just be true free trade. But that has not been the case, and it hasn't been for literally decades and decades. And many of these countries, as I stated earlier, have really been taking advantage of the situation and making the U.S. companies pay extraordinary tariffs sometimes in many cases. Now, ultimately, what the Trump amendment, one of the main goals of this, using the reciprocal tariffs, is to bring manufacturing back to the U.S. so that we can build things again. A country and an economy it's not really a true economy unless it makes stuff. I mean, that's just the reality. And the U.S. barely builds anything anymore and has been weakened as a result of that. It's also important for national security. We saw during the COVID shutdowns where we found out something like 90 or 95% of prescription drugs were made in China. Well, what if the U.S. and China situation, let's say they decided to do something in Taiwan and we decided to put on some sanctions or whatever, and pretty much all prescription drugs were stopped? That would be devastating to our citizens, to the people that live here, especially those that needed those prescriptions. We should have some mechanisms in place. I'm not saying we should have to make everything here, but certainly we should make a certain percentage and things that are keys, things that are important. I think the ability to build our own weapons, ships, for example. Apparently our U.S. shipping production ability is pathetic. Those kind of things need to be brought back. And by the way, many of those things, making pharmaceuticals, building ships, whatever, often are good paying jobs, which would be good, again, for Americans, for citizens, and for the economy. So the short-term pain, there would be a long-term gain, no question. If a company decides they want to avoid the reciprocal tariff, they can start building whatever that is here. If you're going to build cars, for example, I think it was Nissan announced that they're bringing some manufacturing, or Honda it was, some manufacturing to the U.S. That's great. Well, building a car factory probably going to take a couple years. That doesn't happen overnight. Again, it's that process. Short-term pain for long-term gain. So the question I get asked again, in particular to like the stock market and things like that, what should you expect? Volatility, at least for a while. Uncertainty. There really is uncertainty because, again, most people, we haven't ever really lived through anything like this, where the reciprocal tariffs and making significant change to tariff policy that's been in place for decades. It's really not, no one's really certain of what's going to happen. And again, that's not typically good for the markets. I'm fully in favor of the actions they're taking because if they're successful or even somewhat successful at accomplishing bringing U.S. manufacturing back to levels we haven't seen in decades, the long-term benefit for the U.S. will be tremendous, and it'll be tremendous for decades to come. So what these statements are making about the golden age of America, these things could be very much true and very encouraging, very exciting. But as I stated, word of caution, probably not going to happen overnight. We've got a transition period we're going to be dealing with. We have some economic uncertainty. We're going to have some volatility, and that's likely going to occur for the next year or so. We got to get through 2025 and get into 2026. And then we should start seeing some things starting to settle down somewhat and improving, frankly, also. So there's a lot to look forward to. There's a lot to be excited about. I'm encouraged about the future, economic future in particular, of the country for the longer term, much more than I have been in quite a while. But I also still understand, and have to be a little practical here, that the short term could be really challenging. So again, what do? Reduce your risk, reduce your exposure, reduce your exposure to the volatility and the uncertainty. Set aside some of the money, do what the institutional investors are doing and the Warren Buffetts of the world, the big boys, where they're moving to safer assets. And things that are liquid, so they have access to those monies so they can then re-engage when the opportunities that inevitably will come. Look, if we get one of the best things, and Warren Buffett says it all the time, is one of the best things is, bad economic news is actually great for investors because it gives you opportunity to buy. Now, that is true if you've got some dry powder, the term that's used. If you stayed fully engaged and hung in there, is the advice we often hear, and rode the roller coaster down, and you don't really have much in reserves, you don't have much option or choice, do you? You just kind of got to stay with the ride and wait for it to take you back up again, which likely will do eventually. But again, typical bear market, top to bottom and back to where you started, is 5 to 10 years is the typical historical averages. Look at the charts. I'm not saying anything that isn't public knowledge. But if you set some money aside in a personal bank and it's insured and guaranteed and highly liquid, you're earning 6% plus, tax-free, and then the market takes a correction and prices drop significantly and you want to access funds from the personal bank and re-engage, more power to you. In fact, that's often what I see where real wealth is built. I got some more things I want to share with you. Is this just a correction or the beginning of the next bear market? And there's some things that are pointing towards what might be going on. Some charts and some things I'm going to share with you that might help you determine that a little bit better. So stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So I love this Fortune article. Kind of ties into the whole thought that I've been sharing today. Is the title of the article states, Warren Buffett saw the sell-off coming and hoarded cash. Analyst says, as markets await his next move, patience is more than a virtue. It's a weapon. Making a point that I was just stating in the end of the last segment is, look, if you take the typical advice, which again I find ironic, hang in there, it'll get better eventually, and you ride the roller coaster down. Let's say this is a bear market, and it takes several years, typical, to get back to where you were. It oftentimes can take upwards of 5 to 10 years, top to bottom, back to break even. That's not uncommon. But if you get off the roller coaster or take some of the money off the roller coaster, off the ride, protect it, guarantee it, ensure it doesn't lose money. And like I said, your personal bank's a great place to park money for a while, earn some interest on it while you're waiting for that opportunity. Well, then you can take advantage of that opportunity when the markets do correct. And that's exactly what Warren Buffett, well, as this article states, is doing. He did the same thing in 2007, and he took advantage of opportunities when the markets took a significant correction or bear market from the Great Recession. And he states, history shows Buffett turns to a net seller when he anticipates periods of subpar market performance. I've shared this a number of times also, that recently Goldman Sachs, JP Morgan, BlackRock, Vanguard analysts have all come out making statements that they project a 3 to 5% S&P 500 average annual return for the next decade. Why are they saying this? Partly because the last couple of years were so tremendous, 20 plus returns back-to-back years in the S&P 500, for example, that if you look at history after those types of tremendous upsides, the markets tend to stagnate or even drop for quite a while, because it just needs, if nothing else, it just needs a breather. But there's some other things that are kind of giving us some insight to a little bit about, is this likely to be, again, just a correction or something more? And this Market Watch article is stating we're now in a stock market correction, pullback, or bear market. That's the big question. And they refer to several charts to look at that kind of give you a hint of where things are at. The point they're looking at is lower highs and lower lows is bearish. And if you look at the chart since the peak, overall, the market's never go in a straight line. But when you see the lower lows and then lower highs, so when it bounces up, it doesn't bounce up quite as much as it did previously, that's a bearish signal. And we are seeing that for the most part. Like I said, the bond market's been sending a lot of messages lately about potential recession with the bond yield inversion and all those types of things. And certainly probably the big one, there's a chart that's the economic policy uncertainty. It's at a very high level. In fact, one of the highest levels on record ever. And that, again, that is one of the big causes of concern, is how are these reciprocal tariffs and all these types of things that we're going to be dealing with soon, how is that going to affect the economy, the markets, businesses, profits, all of those types of things. Here's another indicator oftentimes to give us an idea of where the economy is really at, and that is U.S. consumers are pulling back spending on dining. Going out to eat is kind of a luxury, and it's usually a pretty early indicator of economic strong periods or weak periods. And we're seeing some of the largest declines of dining out that we've seen for many years. In fact, the restaurant sales have plummeted by 8.5% annual rate over the past 3 months, which we haven't seen that type of reduction since the COVID shutdown. So again, that's not a positive sign. That's a negative. That's a weak sign. Another one is the number of Americans working more than one job has never been higher. And this is a lot to do of the causes of the cumulative effect of inflation over the past 4 years is causing people to have to work multiple jobs just to make ends meet. Another issue that's a sign of weakness regarding jobs is that the U.S. economy has become far too dependent on government jobs. In fact, over the last 4 years, over 2 million jobs have been government jobs. Most of the recent job growth in the United States over the past 4 years has been due to these economic jobs. Now, of course, that is starting to reverse itself with DOGE and the Trump administration reducing government jobs. And this is starting to show some real economic weakness. And here's an interesting one. DOGE identified that there's apparently about twice as many government-issued credit cards as there are government employees, and most of these have like $10,000 credit limits. So they temporarily at least shut them all down, and they were going to cancel them. until they can figure out which ones were legitimate and which ones weren't. But there was a court order stating they couldn't do that. So again, these are smart people. I thought this was brilliant. They just didn't cancel the cards. They just changed them all to a $1 spending limit. It's pretty brilliant. So it satisfies the court order, close the cards, but people can't really use them anymore until they figure out again which cards are legitimate and which are not. You can't have twice as many cards as employees. That makes no logical sense. No company would do that. Well, the spending cuts with the cards apparently has affected the airline industry significantly. Apparently, the airlines have reported that government travel is down a massive 50%. Every one of the major airlines, their stock prices are down. They are guiding down for their profits significantly. And the stock prices of all these airlines are really getting hit big time. It's kind of an interesting side note of what's going on. So certainly the airline industry is in bearish territory. That's for sure. Also, the same government employees are no longer traveling, are now filing unemployment claims. There's been over a 400% increase in unemployment claims year to date. That's kind of a crisis from former government employees. And that's why you're seeing things like this Business Insider article where it discusses an AI stock picker that beat the S&P 500 last year, which was pretty impressive because the S&P did really well, is dumping tech stocks. I found that quite interesting. And Business Insider is warning that we're seeing the unwinding of a bubble and the tech stock sell-off has room to run. We'll see what happens, but these things are certainly pointing to we might be in something more than a correction, if you know what I'm trying to say. We might be the beginning of the next bear market. We'll see. This Market Watch article I thought was very appropriate when it was stating the S&P 500 correction shows why risk tolerance matters. Your portfolio drops 20% this next month, and that could happen. Are you going to lose a little sleep? Is that going to bother you? You're going to not want to open up your statements. Those are all signs that maybe you're a little bit over risk to your comfort level. You don't want to do more than studies show that about 80% of Americans are not they tend to be pretty risk adverse especially when it comes to their investments. And I find typically once people learn that there are other options like your personal bank or annuities or guaranteed lifetime incomes where you can get nice returns, again, 6% plus tax free. We've got annuities that are paying upward 7-8% guaranteed first year. Someone paying 16% signing bonuses up front. Tremendous unlimited upside potential with no downside market risk. Or you take a guaranteed income rider if you want to create a pension for the future, and some will pay up to a 30% signing bonus. Others will increase your guaranteed income, your pension check, if you will, by 10% per year. Each year you defer it. You can increase the amount of money you can receive for retirement tremendously if you're willing to defer for a little while. The point I'm trying to make is when I find people learn that these other options are available, if you increase your guaranteed income for life by 10% a year, and that's kind of like increasing your portfolio by 10% a year. This is guaranteed. It's the amount of money you're going to have available to live on, supplement retirement. And it's particularly powerful with IRAs, 401ks, because those by definition are retirement accounts designed for income in the future. Well, if you can increase the amount of money you're going to receive for income, say 9 or 10% a year, each and every year guaranteed, well, that's like equivalent getting a 9 or 10% return on your money each year. Most people are happy with that type of thing. And what I'm trying to get at is when people learn about these options and realize these are viable for them, oftentimes they are inclined to reduce what they have at risk to the markets because these are guarantees and it fits their risk profile, their personality more. And by the way, don't feel bad. It's about 80% Americans. Studies show this. If you want more information on this, like I said, contact me at yourpersonalbank.com. I'm going to share a few more things I think you're going to find interesting about what's going on with the government and the debt and things like that. And maybe some solutions or some thoughts that I think you'll find very beneficial. So stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. This last thought I had, this article I thought was great from Business Insider, and it stated, on the anniversary of the dot-com bubble bursting, is history repeating itself? This was really quite interesting because 25 years ago, we saw a tremendous bubble burst in the market. It was led by the tech stocks. I remember this. I was early in my career. It was like it happened about in the first year or so of my career in the financial industry. And it was tremendously jarring and shocking for a lot of people because there were a lot of serious people at that point saying, oh, because of the dot-com stuff, that the stock market would never go down again. Of course, that turned out to be incorrect. Top to bottom drop, S&P 500 was 45%. And it took nearly a decade for that to recover. We had the lost decade, if you remember. It's ironic that this current correction is being led by the tech stocks, which were also the ones that led the charge, particularly in the last couple of years, the Magnificent Seven. All of them are basically down about 20% or more at this point from the peaks. Where are they headed from now? Here, where are they going to go? We've discussed a lot of that in the previous segments. There certainly are significant reasons for concern, at least of uncertainty, volatility at the very least, again, primarily with the tariff policies that are going to go into place. And as I stated, it's not something I'm against. I think it's a short-term pain for long-term gain situation. We do need to bring manufacturing back to this country. We do need to have a fair trade situation rather than free trade where we're not getting taken advantage of by other countries. That's going to help our industries here, which is going to create more jobs, strengthen our economy, all kinds of good stuff. But, yeah, there's going to be some pain. Let's just say the next year or so, there's going to be some volatility. It's going to be a transition period. Remember, we're upending decades of economic status quo with tariff policy and et cetera. Another big problem, of course, we've discussed this many times, is the interest on the debt. In fact, in the last 5 years, it's doubled. And these are things that are going to be needing to address because these are unsustainable numbers. One of the ways to solve that is to improve our economy, increase our economy, and by having fair trade, that's one of the, bring more manufacturing here, produce more, make more. That's one of the ways to solve the problem. There are other solutions to this too. We've discussed this on previous shows. But the thing I want to touch on right now, a little bit on real estate. You know, I've got a lot of clients who are real estate investors. Your personal bank is a tremendous fit for those types of investors. They typically have a need for large amounts of cash. They understand leverage. I mean, that's how the entire real estate investment world works for the most part. In most cases, you put some money down and you leverage, you borrow the rest to invest in an asset or piece of property, create a cash flow. I mean, that's the basics of how real estate works. The problems, there's some real problems in the real estate market right now, and you got to be really careful. You got to really sharpen your pencil if you're a real estate investor. I'm not saying you can't do it today, but you better know what you're doing. You don't, because it's easy to mess up. Because if we just take a look at, well, for example, the U.S. household income needed to purchase a typical home just in January of 2020 was $51,000. Today, that's $92,000. So in 5 years, the income to purchase the average home in the U.S. has increased about 80%. That is a massive, massive increase. and of course has made housing unaffordable for many Americans. In fact, by any measure, housing prices, it's the most unaffordable time to purchase a home since they've been tracking the numbers ever. So from a purchasing standpoint, if you're trying to buy a home, it's probably the worst time ever historically. And to continue that thought, here's where I'm starting to have some concerns about real estate. A record 64% of new FHA borrowers had debt-to-income ratios above 43%. And again, to put things in perspective, in 2007, that percentage was about half. So in other words, the FHA loan portfolio, that's a significant amount of loans out there, is significantly more risky than it was before the 2008 financial crisis. And right now, in 2024, about 7% of FHA mortgages went seriously delinquent. That means they're over 90 days delinquent, which is actually about the same level we saw at the peak in 2008 in the midst of the financial crisis. Now, why are we not seeing more impacts on this? I shared, I believe, last week's show that the Biden administration has come out, apparently, they were paying the mortgages for about 1 million homeowners in the country to prevent foreclosures, to make the economic numbers look better prior to the election. Of course, all of that has stopped now with the Trump administration. How is that going to affect real estate? We are going to see here in the very near future, because we're only a couple months into the Trump administration, are we going to see more foreclosures coming up? I don't know. But again, housing affordability has never been worse. Housing payments have roughly doubled over the last 5 years. So affordability is at all-time lows. When you get into extremes, whether it's the high end of an extreme or the low end of an extreme, whether it's the stock market or real estate market or any asset for that matter, when you're at those extremes, that's when crises tend to occur. So when you're at the high end of the extreme, the affordability, the prices are extremely high. Again, stock market, real estate market, whatever. When corrections happen, they tend to be pretty big because you built this huge bubble. And that bubble, when it bursts, it can get really ugly. Again, I don't know. I'm not saying we're going to see a repeat of what we saw in 08, 09 in terms of the real estate market. But there are certainly some signs, some factors that are coming up that are demonstrating real weakness. And again, the last thought on this is with extreme high prices, it doesn't take much for a significant adjustment to occur, a crisis to occur. Certainly, real estate is local. There's different regions. Different regions are affected more than others. So it's not going to be across the board type of thing. But I think in some markets, we're going to see some significant adjustments in the pricing of homes. We will see. We will see what happens. But there certainly is cause for concern, and pay close attention. Now, I want to kind of finish up with a few thoughts on some current events that are going on, some things I think are just super important. And I saw this from Thomas Sowell, and I thought this was interesting, where it stated, ours may become the first civilization destroyed, not by the power of our enemies, but by the ignorance of our teachers and the dangerous nonsense they are teaching our children. In an age of artificial intelligence, they are creating artificial stupidity. I couldn't agree with that statement more. And that's why I was so heartened when I saw that Trump signed the executive order to finally get rid of the Department of Education, which is, frankly, in my opinion, one of the most worst bureaucratic wastes of money that we have in our federal government. If you read the Constitution, the federal government has no role in education. That's a state's issue. That's a local issue. And that bureaucracy, which does nothing to teach kids, and we spend more than any other country in the world per pupil, yet have the worst outcomes, and you can point to the beginning of that destruction, that chart, the drop, to when the Department of Education was started, and it's just continued to get worse. Bureaucracy does not educate students. Teachers do. And that's a bloated bureaucracy where there's far more. some of the numbers I've seen, there's about 11 million people in the United States in the education field, and less than half of them are teachers. We need more teachers. We need more good teachers and less bureaucrats and principals and administrators. I don't think anyone can argue that. And one big step towards that is getting rid of the Department of Education, which is just nothing but a blow to bureaucracy that has not only been it's been detrimental, frankly, to the results of students. Now, another quote I saw here that just kind of really hit me was from Thomas Jefferson. To compel a man to subsidize with his taxes the propagation of ideas which he disbelieves and abhors is sinful and tyrannical. Again, another quote I could not agree with more. And then at the same time, recently, we had Senator Schumer on The View making a statement mocking people, as he called it, greedy Americans who want to keep more of their own money. Because he says their attitude is, I made my money all by myself. How dare your government take my money from me? And he was saying it in a mocking tone. In other words, he thinks the government money is his. It's not. The money we earn and we make is our money. We earned it. It belongs to us, the citizens, the individual, not the government. It's his very attitude, his very mocking, that's abhorrent. His attitude is completely the opposite of our founders and our Constitution and Thomas Jefferson's statement, as he stated, to compel a man to subsidize with taxes the ideas he disbelieves and abhors as sinful and tyrannical. And there's no question our federal government has wasted billions and billions of dollars recently. It's mind-blowing the amount of money that they have wasted. And the last thought I want to leave on today, the judicial overreach that we're seeing with many of these district judges doing things like telling the military they have to recruit transgender people, or instructing the Trump administration that Venezuelan gang members that are on the plane to an El Salvadorian prison, the plane literally has to turn around and come back. Thankfully, they did not listen to that judge's order. They were apparently in international airspace, whatever. But there's almost no one who wants Venezuelan illegal gang members in the United States. I don't know what this judge is smoking. It's ridiculous. But I saw this quote from Abraham Lincoln, and he stated, "We the people are the rightful masters of both Congress and the courts, not to overthrow the Constitution, but to overthrow the men who pervert the Constitution." That is such a powerful statement, and we have some of these judges trying to pervert the Constitution. A district court judge does not have authority to override the President of the United States on immigration issues, for example. That's clearly an Article 2 power of the executive, and the Article 3, which is the judiciary, has no role in that. They're way over their skis on this. The Supreme Court, frankly, should step in and put a kibosh to this. They're responsible. These district court judges are people who are attempting to pervert the Constitution. Stay tuned next week to the Your Personal Bank Show for more helpful, beneficial information. And as always, as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.